Hello everyone, in this video, I aim to teach you the most important aspects of technical analysis in an accelerated training format. Indeed, this video is prepared to provide you with a comprehensive education, allowing you to master almost the entirety of trading from the lowest to the highest levels. Please, watch this video without skipping from start to finish because it is crucial to fully grasp the information in order to learn technical analysis and make it a habit to increase your capital. This video is designed to cover approximately 90% of technical analysis. Let's get started. Firstly, after a descending trend, we observe that a bottom level is formed, and later, after the price increases somewhat, it falls below this bottom level again. This type of movement occurs as a liquidation hunt conducted by market makers to clear stop-loss orders accumulated behind a formed bottom or peak level. In this way, the market maker eliminates orders behind the latest bottom or peak level, allowing them to influence the market in the desired direction once again. After the market maker eliminates the stop-loss orders at the lower end, incoming buyers push the price up slightly, and the region marked with a yellow rectangle becomes an order block. Order blocks are areas where the limit orders of buyers or sellers who have reacted to the price are located, and even the opposing group that wants to reverse the trend intervenes directly with a market order. When the price revisits the order blocks, another reaction is expected, but if the order blocks are tested more than once, their strength diminishes, making it easier to break through. When the price starts to react and rise from the order block you see on the screen, a fair value gap area is formed between the three consecutive blue bars. Value gap areas are structures that occur due to weak or non-existent orders from the opposing group in the order book. In other words, they are formed due to gaps in the order book. When they form just above order blocks, they are referred to as a fair value gap. However, if these gaps occur within the trend, they are called liquidity voids. Both the value gap areas in the trend and the void structures in the chart are referred to as imbalances, and generally, the market will eventually make a move to fill these areas. And as you can see here, after the price rapidly rises from the order block, it creates a significant value gap structure. In a very short time, it not only fills the value gap structure but also revisits the order block area. Although the price that always reacts from the order block quickly fills the significant value gap structure formed just above the order block, can it always fill it so quickly? The answer to this question should certainly be no. Despite seeing this example, do not assume that liquidity void structures will be filled so rapidly. Now, we will see if the price, revisiting the order block, will once again receive an upward reaction from this region. Following just one candlestick within the order block area, we can observe how buyers with strong limit orders react to the price upwards in this formation. The price, with a voluminous engulfing candlestick, forms an engulfing candlestick pattern by completely engulfing the previous black candlestick. Engulfing candlestick patterns provide important clues about the direction in which the trend may turn and are valuable for aggressive traders and scalpers. For them, this formation is quite valuable and sufficient to enter a trade. They place their stop-loss levels just below this structure, taking low risks. Also, if the price touches the stop-loss level and the trade automatically closes, they gain time to enter another trade. Of course, at your current learning stage, I do not recommend this method for entering trades. As you gain experience in trading and ensure a consistent increase in your capital, you may consider closing short-term trades using engulfing formations like this one, allowing you to maneuver swiftly in the market. We can see that the price strengthens its upward movement with the reaction it receives from the order block. At the same time, the closing level of the giant blue candlestick that forms just above the recently created peak level indicates a change of character in the market, signaling that the trend has now reversed. The change of character zone is formed with the upward violation of the peak level made at the end of the descending trend. From this point on, market participants start considering long positions rather than short position opportunities. Additionally, many traders anticipating such a change of character breakout enter the trade at the closing level of the voluminous candlestick formed just above the last peak level. This can be considered as a second entry alternative for traders. At this stage, traders who are still expecting a pullback and want to enter the trade after the pullback are waiting. After a high volume uptrend, we are now witnessing a significant pullback towards the order block. Professional traders typically do not feel concerned about such pullbacks. However, novice investors might panic and manually close their positions during such movements. These deep pullbacks can be orchestrated to evoke concern among small investors and traders who have not reached a professional level yet. Market makers often execute these moves to easily generate more profit and, at the same time, influence the market in the direction they desire. Meanwhile, as the price undergoes another sharp pullback towards the order block, we can observe the formation of a value gap structure where significant bearish candlesticks are forming. Value gap structures can occur in any part of the chart. This time, it formed during the intense pullback towards the order block. It is crucial to keep in mind that the imbalance decline here will be somehow filled by the market. As we continue with the price action, we observe the reactivation of buyers from the order block, filling the value gap structure formed during the decline, and pushing the price upward again. The buyer group prevents a new change of character structure, disallowing a reversal of the trend to the downside. Therefore, investors still looking to enter a trade should keep an eye on long position opportunities. With the intervention of the buyer group, the price resumes its ascent and now clearly takes the form of an uptrend. Additionally, as the price starts to rise again, it leaves gaps in its path. However, as I mentioned at the beginning of the video, since the formed structure is within the trend, it occurs not as a fair value gap but as a liquidity void. In the end, whether it's a fair value gap or a liquidity void, both are referred to as imbalances. After a rapid ascent, the pace of the price slows down, forming a new horizontal market at the upper level. We can observe that the price creates a consolidation zone again in this area. Now, it is evident that both buyers and sellers refrain from entering the market in this zone. It is advisable to monitor which direction the zone will break and refrain from opening trades in this region. For investors entering long positions in the lower part, taking some profits in this formed horizontal market might be a sensible choice. Please pay attention to this wick extending above the newly formed consolidation zone. Here, the buyer group executes a liquidation hunt, creating an impression that the trend will continue upwards. It's a trap set for those who act impatiently, thinking the price will move up again within the consolidation zone. Many inexperienced investors, lacking technical analysis knowledge, fall into these traps and enter trades within the consolidation zone. Of course, it should not be inferred that no trading can be done within the consolidation zone. There are trading opportunities based on technical analysis methods even in horizontal markets. However, we will not delve into this topic in this video. Instead, we will learn how to execute buy and sell transactions in horizontal market conditions in our upcoming videos. Please don't forget to watch the videos until the end, and I would be very happy if you subscribe to the channel and hit the like button. Thank you. Let's continue. I would like to draw your attention to the downward break of the consolidation zone where the price has been range bound. Entering a trade with this setup, despite the lack of confirmation, is not necessarily a flawed idea. However, since it goes against the previously established bullish trend, it would be prudent to keep the profit margin low and execute a quick in and out trade. Please remember, when engaging in market trading, you must consider your logic, psychology, and risk-reward ratios. Otherwise, it may turn from trading into gambling. If we assume that we entered the trade when the zone broke to the downside, and with the stop-loss level, of course, being above the consolidation zone, as you can see on the screen, the price tests inside the consolidation zone twice before turning its direction downward again. And as the price turns downward, we can see it filling the liquidity void structure formed shortly before, continuing its downward trend. As you can observe, these gap areas, referred to as imbalances, are potential formations that can be used as targets. Professional traders pay close attention to these structures, establishing them as entry and target levels in their trades. These formations are crucial for technical analysis. In this short video, I aim to discuss several key elements of technical analysis and illustrate the formation of valuable structures even in a brief price action. Please save this video, and if you aim to profit from the markets and increase your capital, don't forget to watch it repeatedly. Subscribing to the channel and liking the videos would be the greatest support you could give me. See you soon, and take care.